Broadcast is now starting. All attendees are in listen-only mode.
Welcome, members and guests, to the Virtual Investment Club of Sacramento. We are a better investing model club open to the public. All of our meetings and stock studies are virtual, allowing us to have members from around the world and the U.S., including Canada and China. I am Joanne Obata, the president of the club, and guests, you will be muted during the meeting as observers, and will have an opportunity for questions and comments after the meeting ends. The stocks presented today, actually, we are doing stock reports. Our quarterly stock reports are for educational purposes only and are not intended to be a recommendation for buying or selling any stocks. We ask that you conduct your own review and analysis of any company of interest before making an investment decision. The views expressed are those of members and do not necessarily represent those of Better Investing. This meeting may use products or services not endorsed by Better Investing. I just want to let you know also that this is a meeting that is a non-standard meeting because we usually have an education topic or a stock study. And this month we will be doing all quarterly reports. So welcome everybody, and we can get started with our treasurer's report. And I will turn it over to you, Roy. Let's see.
Is Roy muted?
I don't think so.
Yeah,
Oh, yeah,
I am.
he was.
Oh, you were?
I think I did. Did I accept it?
Yes, you did. We can see it.
Okay.
Screen.
So let me go to slideshow. All right. I'm filling in for Haney. Unfortunately, his mother passed away a few days ago, so he's tied up with everything involved with that. So I'm doing the treasurer's report this month. Last month, we voted and did sell 2 stocks. And for those of you who are visitors, when we buy a stock, we buy $1,000 worth. We sold Middleby, 16 and some shares, at just under $100 for $1,600.70. So we had made a profit on that. We also sold Realty Income, which is a REIT. And on that one, we sold it for $983.32, which shows that we took a small loss. So we track our portfolio 2 ways. We have Morningstar. We use their portfolio system. And this shows all our stocks and the gain or loss in them by purchase date. If you look at the left side, initial purchase, it has all of those, including when we bought something 2 or 3 times. This doesn't lump it together. Each purchase is shown individually. And you can see in red if we took a loss, but in black is the where we got a profit. We also can shift it around and look at it by gains. You can see we made the best gain was with 5 below. IBGP is doing well, and on down, and we have a few down here at the bottom that aren't doing as well. We also track our portfolio using my iClub. And here, all the purchases are consolidated into one line. So like if we bought more shares of Disney, it just shows up here. And like, $2,300.10. And if we went back to Morningstar, it would show that we purchased it twice. But with my iClub, you only get the one consolidated number. And then we break it down by company size. And this was a surprise to me. We have one micro-sized company by sales, but that could be because it's a bank, and banks don't really work all that well with some of the products that BetterInvesting and iClub Central have. And we have micro company, some mid, and a few large. So that's, and we have 22% large, which isn't too bad because BI recommends 22. Mid-sized companies are 36, and they recommend we have 50%. And then the let's see if I got this right. And then the mega companies are 10. So 10 and 22, that's 35. So we're a little heavy in the large companies. And here's another breakdown by pie chart that shows how we've diversified our portfolio. And we also have it by sector and industry. And this is the written chart, which we also then break down. And Morningstar, which is what we rely on for our information, they, I think last year, came up with these super sectors. So they take their sectors, but then they group them together: sensitive, cyclical, and defensive. And we're very low in defensive and overly weighted in sensitive. But that's our portfolio by that. And then industry and the actual companies themselves. And you can see right now we have a lot of cash, but they're pretty good breakdown in our other ones. And it also tells us what sectors we don't have. So if we wanted to look at getting into another industry, this is something we could look at and decide on. So that's the treasurer's report. Any questions?
Roy?
Yes, I just have a comment on your Michael revenue on Ozark, because it's a bank, and this report is generated based on the revenue. But for bank, we don't just simply look at the revenue. Actually, their primary source of a bank revenue and earnings are from the assets. So technically speaking, for banks, supposed to look at the assets growth, which for Bank of Ozark, it's about 21 million. So yeah, if we only look at the sales itself, yes, it's very tiny. But for bank is exception.
Right. And that's what I pointed out, that it could be just because it's a bank. So thanks for that explanation.
Right.
And if there's visitors on tonight who are new to BetterInvesting, when we go by size, we base it on sales. Where the rest of the financial markets base it on capitalization, what the price of the stock is times the number of shares. We don't think that's as meaningful because a small company can grow faster than a larger company. They can double their sales, but the actual price of the capitalization is almost by whim of the mutual funds and others who would buy or sell their shares. So anyway, we base our size on sales. Okay, and let's see how
Bernard, did you have a question?
Well, it's just, yeah, Bank of Ozarks is considered a medium-sized bank. It's even past beyond small. It's considered a medium-sized regional bank. As I understand it, it's 20 million in assets.
it might be, but by the
By revenue
criteria that VI and iClub Central use, it comes out funny, I'll say.
Yes, that's
It's
correct.
It's not completely accurate for analyzing banks.
That's
so,
correct.
Joanne, do you want to back?
Yes. Actually, so we don't have a stock study for this month, but next month, I don't know, is Matt on the line yet?
Not yet.
We'll have Jay, Andrew, and Matt. And so now the next portion of our meeting, we will go through our quarterly reports. And Tom you will be presenting BIIB, and I will transfer the screen over to you.
Okay.
Okay, just a second. Oops. Here we go. Sorry.
That's okay.
Okay.
So can you,
Yes, I'm making you
do
the
I need to
presenter.
accept it or something?
Yes. Do you see it?
Yes.
Oh, and before you start, Tom, just
Yes.
since we're all starting, we're still developing our protocol on these online meetings. Let's try to let the presenter give the full presentation, and then when they say questions, then we can ask questions instead of interrupting the presenter. Is that okay with everyone?
Yes.
Okay.
Yeah. Okay. So now I've got my paper, my report here in the middle of the screen. Can everybody see it? I can't see what everybody's seeing.
Can you make a little bigger full screen, please?
That's full screen. I'm not quite sure. I guess, wait a minute here.
Yeah, maybe you do Control
I
Plus.
guess I could go into my browser and do the Zoom or something.
Jay,
Just
if you
do
go to the
Control
top,
Plus.
if you go to the top of your screen, it'll say Zoom 100%, and then you can click 100%.
Well, I'm
This
at
is better.
120 now.
This
Is
is
that
better.
okay?
Yes, it's better.
Do you want it even bigger?
It's better. This is good.
I can see it fine.
This is
Okay.
good.
Okay. So my company is Biogen, or a biotechnology company. I didn't make any changes to the stock selection guide. What is our projections are currently 6% for growth for sales and 6.8% for earnings per share, and they beat that as far as sales growth. They got 9%, but they only had 2.7% earnings per share growth. So they had increased, that they do their non-GAAP, to make everything look better. But the GAAP reporting was 2.7%, and they have increased when they have increased spending on research and development, also on sales and marketing. They acquired some new drugs, and they paid some money for royalty agreements that they think will pay off in the long run, but so that decreased their earnings per share. The current PE is 18.5. The average PE is 20.5. So it's a little less than the average, 90%. The upside down ratio came out to 2.3 to 1. Compound annual return 5.8%. Their best-selling drug called Tecfidera, which is a multiple sclerosis drug, is facing increased competition. Sales are declining in the U.S., but they're increasing abroad. Interferon sales, which is also used for multiple sclerosis, is decreasing, and they expect further declines. And they're facing some price reductions in European countries, which have price controls on their drugs. Their one drug that is increasing in sales this quarter is called Spinraza, which is for I can't think of it anyway. Some sort of spinal cord condition. It's a genetic spinal muscle atrophy or something like that. So anyway, the growth is moderating in the U.S. Part of that's because of the dosing regimen, which there's, and when they initiate it, they give 4 doses in 2 months, and then 1 dose every 4 months. So the first year they charge $750,000. The next year and subsequent years it's $375,000. So new patients are twice. You get twice as much revenue. So the Spinraza sold increased abroad dramatically in the second quarter. But also competing drugs could be launched from other companies in the next couple years. They have some promising drugs in clinical trials. And well, that's a repeat on the R&D and sales and marketing. There's a British agency called the acronym NICE. They control drug prices in the U.S. They denied coverage for Spinraza because they thought it was too expensive for the clinical benefit to be achieved. And China has published a list of drugs. I think it's actually 48 rather than 35. But anyway, they have drugs that they would like to get quickly approved in China. There are a lot of them are cancer drugs, and the Spinraza is on that list. So it should be approved in China relatively soon, probably within a year is the hope. But I don't know what reimbursement or anything would be like. I don't know the Chinese market. Their drug that they've had, the famous Alzheimer hope, aducanumab, if that's how it's said. Phase 3 trials results are expected end of 2019 or 2020. The share price increased quite a bit here recently because they released some results for an Alzheimer's drug called BAN 2401, but then the price dropped about 10% when the next day or so after investors realized that patients were not significantly improved by all standard measures, you know, how they measure people's cognitive and physical abilities. And also the control group, they thought, may have had more patients who were predisposed to declining faster, having less healthy patients or more Alzheimer-prone patients in the control group rather than the experimental group. So they need more studies on that. They have 3 Alzheimer's drugs that are promising, but success isn't guaranteed. They've all been shown to decrease what's called beta amyloid in the brain, but other companies have had drugs that did that, but they failed in phase 3 trials. So, you know, we'll just have to see. So, you know, my take on it is that it's a hold, and you know, I think the stock price is propped up by the hope of Alzheimer's success in the future, but you know, that isn't guaranteed, and we won't know about that for, you know, probably another year or two, or maybe even longer on this BAN 2401, because the phase 3 trials haven't even started on that. So I don't know, does anybody have any questions?
I do. So the return is like less than, what is it, like 5%, 6%, the projected return? 5.8.
Yes.
So you have a recommended to hold, but do we think our return is going to go up, or?
Well, no, nobody knows. I mean, like with the drug companies like this, their future depends on the clinical trials of the drugs that they're developing, and
So would we be better off
it's
selling?
unknown.
Would we be better off selling and then repurchasing later on down the road?
Oh, this particular company?
Yeah.
Well, that's called market timing, I guess, which is kind of
Which we don't do.
against BI principles, but that would be an approach, yes.
Yeah, I would think maybe, you know, we could swap it if we find a better drug company, but for now, I'd say hold it.
I would agree. There may be other candidates out there. Over the next month or so, I can scout around and see if I find anything more interesting.
Okay.
I'd be interested it's in the insider situation. Are the insiders buying or selling?
I don't have any idea.
Yeah, okay.
Tesla was down big today, so maybe we could consider that.
I don't think so.
Drive right off a cliff, huh?
Okay. Uh, so, any other questions for Tom?
Not I.
I'm good.
Okay, we don't have, Mina's not on the line, so the next,
Do I need to do anything to
I'll
hand it
I'll
back?
take it, Tom, from you.
Thank you.
Let's see. Okay, the next person is Roy. So, and we'll get back to Mina when he comes back on. So,
All right.
okay.
Let's see.
I'm going to make you presenter, Roy.
All right. Okay. Here is the report I did, and as you can see, the sales growth for the quarter was down. Not just less, but actually was negative. Or actually, it was down 0.7% from a year ago. But I had to dig for a while. It took a while to find, but it was because, or it seemed mainly because of the ban that the government had on ZTE. But that's been lifted. They project their further sales at 11 to 13%. And reading the conference call transcript and seeing some other things, the analysts did not seem troubled by this drop in sales. And in fact, this negative 0.7 was higher than what the consensus average was. So, and they liked the 11% to 13% growth. The earnings projection is 14%, and they came in at 18.9, which seems weird that you'd have such a low sales and have good earnings. Well, they trimmed back on a lot of their expenses. And then the other thing is because of the tax cut and Jobs Act, their taxes fell to 9%, down from in the 30s. So they saved a ton of money in taxes. So that's why those numbers look so good. I kept, for the most part, the judgments that were already in, that I've been using the last 2 quarters. But actually, I get to that in a moment. The current PE is 14, which goes with the price dropped the last couple of months, which was due to the reduced sales that the rest of the people at first panicked on. The average PE is 16.6, so the relative value is 84.3. Now, when I did the double check the SSG, I changed it from the normal calculation I do, which is 4B1 or 4BA, to which gave it a 4.8 to 1 upside down ratio, to a more conservative low recent low price, which actually wasn't in this year, it was part of last year, but which shows how much the stock had gone up earlier this year. But anyway, I used that lower number. I still got a 3.6 to 1 ratio, and the compound annual return using the average PE, not the the one that's really wild, came at a 15.3 compound annual return. As far as risks go, they do have a lot of business in China, and if that trade war gets really serious, that could impact them. But they believe that they have enough business that they'll just won't be hurt much at all. They're heavy in mobile, and they're growing in the Internet of Things, the IoT, not only in the United States and Europe, but also in China. And with 11.3 sales growth and 16% earnings growth projections from the company, I think those are reasonable, given everything they're in. And it's like an octopus. And they beat the consensus estimate for both sales and earnings, and so I think they'll at least meet their projections. And then based on what Doug Gerlach presented Saturday, I also looked at profit margin, which is 34.8%. And looking at the past years, it's about the same. It's up slightly, but it's it's at the basically 35%, which is not bad at all. So the way I view this is, yeah, the price is down, the sales were down, but should rebound. And this is one of those situations where the stock is on sale, and I like to buy on sale, and I think this fits that criteria. So that's that. Do you want to see the SSG, or is this, you ready to go on to the next company?
I would like to see the SSG since you recommend to buy.
Okay, so here it is. And you can see right here how the EPS is going up faster than the pre-tax profit line. But that's because, again, of that 9% in tax rate. I kept the 11 and 14%. They have, again, zero debt, which I reported on last quarter. I love that. They've got great pre-tax profit on sales, which is the profit margin. The return on equities exceeds the average. It's 25%, which is very good. And then they do give dividends, and that's been going up substantially, but the payout ratio is in the very, very low 20%. So they're not cannibalizing other products just to pay the dividend. That's easily handled. You can see the earnings per share has gone up, and with these numbers, I use very low numbers of 18 for the high PE against that 14% earnings growth to give a 228 high price. And the low price, as you can see, I use this recent market low of $54, which is less than the forecasted low price. I did that on purpose. And it's a 3.6 to 1. And its forecast average PE return is 15. If you wanted to use the forecast high, it's 21, which it should be giving us a really good return over the next 5 years.
Can you go back to the front page?
Yes. Whoop. What would you like to see?
Well, it just I'd like to see more pre-tax profit growth. It looks, it looks like, the last 15, 16, 17, it's just like it's tapering off. Looks like, well, I think sales look like they're doing better than the pre-tax profit, just the way I'm seeing that line.
Yeah. I mean, the last 2 quarters pre-tax profit came out a little less, but I think that's because the sales have dropped off. But both quarters were affected by the ZTE embargo. And with that turning around, so if they get their sales back up, that pre-tax profit will go back up to normal. If you look here, you can see what pre-tax profit is over the trailing 4 quarters, and that's pretty substantial there and here.
But they had strips for the 12/16 through 9/17 in that column.
Mm-hmm.
What is ZTE?
It's a Chinese company. I think it's a cell phone, but I'm not sure. It could be a technology company. Jay, do you know?
I know, I never heard of it. I don't think it's a cell phone. It could be a
Yeah, I think it's another technology company. It's the one that the Trump administration slammed heavily and cut off all sales to it for several months.
Did you say ZTE?
Yeah.
Oh, is this a mobile phone? I don't know that one.
Yeah.
Do you know, Jane?
I don't.
I don't ever
Because
heard
they
of it.
felt it was actually a government, not just a government-run company, but it was stealing a company that was trying to steal secrets.
Is that the one that Huawei? No, it's not Huawei.
No,
No.
Huawei's a different company. Well, I think it says they make telecom equipment. I think they make routers and things like that.
Yeah.
I guess there's some security concerns with them too.
Right.
Hmm.
I still have those, but apparently the Trump administration is satisfied. Anyway, so they're trading again with them. Although it just started, so they don't expect that the next quarter will actually show much result. But in the coming two and 3 quarters, it should be back up to normal.
Based on their company's website, they are headquartered in Texas.
Okay.
I did not know this company.
Oh, ZTE?
CTE. It said that it's the second largest supplier for prepaid devices.
Yeah. Well, they may be headquartered there, but they're not a Texas company.
I think they did that for political reasons.
Yeah.
Yeah.
So anyway, that's the story on Skyworks solution. And you can see here that black line, that's the profit margin, and it's pretty, even, but just a slight rise to it. The earnings, pre-tax profit and sale, well, earnings are up. Pre-tax profit dropped a little bit, but that's because of the sales dropped. You can see they're right in line with sales. But, with the sales picking back up, everything else should be back up as well. But even with that drop off, the profit margin being up, the management seems to be doing, working magic. So.
Did we buy Skyworks just a couple months ago?
I thought let me see.
I thought you recommended to buy Skyworks before. I thought we already purchased.
Well, let's see.
We purchased it once or twice?
I thought it was more than one time.
Twice. We bought it again in February. We bought it in January of 2017. We bought it in February of 2018.
Okay. So what's the percentage for Skyworks?
Tell you what, a better one. Let me.
Yeah, if you just scroll down your presentation,
Yeah. So Skyworks is 6.5%.
Interesting. Only 6 at 5. After. Okay.
Well, one of the positions we bought at more than today's price.
Yeah, that's why it's negative.
Mm-hmm. Oh,
So,
But and that's why I think it's I called it on sale.
yeah, we could buy more.
If we only buy companies that are going up in price, I think goes against that's what the rest of the market does, and we're supposed to be smarter than the rest of the market. So.
Okay. So sorry, Roy, if you already mentioned, for Apple, how big is their market share?
I have read 30%.
Okay, 30%
But
Apple.
It used to be a lot higher, and they're now in every cell phone made in the world, and they're going into the Internet of Things.
Yes.
And that's grown to almost 30% there too.
Okay.
So.
Yeah, the time I bought Skyworks, it was because they have both Android and Apple. That was why I bought it. That was wrong before. And but now, okay. Yeah, Internet of Things took over. I like this company. This quarter didn't do well. Hopefully it will back up.
Yeah. I mean, they did have an explanation for it. And like I said, the analysts did not seem troubled at all, which surprised me. I thought they would be going after the CEO, or the chief financial officer, but no. And they expected a lower return, and they actually are not return, but sales, and they beat the consensus. So
okay.
I think that ZTE really put this scare in everyone. So.
But their margins are still good.
Yeah.
Okay, are there any other questions for Roy?
Let me do one thing here. So you can see what the profit margin by itself is like.
Just a second, let me see. I'm not okay. Okay. That's the more okay. Can you explain to me buyback? I actually not very clear how the correlation between buyback shares is that as a positive effect?
Well, what it does,
company.
because there's less number of shares, their earnings per share go up.
Oh, okay.
And they've been putting money in dividends and some buyback, but not as much as some. But I mean, that is a way to inflate your earnings per share. So you have to watch that carefully.
Okay.
Okay, are we ready to move on?
Yeah, very good, Roy.
Okay, thank you, Roy.
Now, you want Jane?
Yes.
I can send it to her.
Yes.
Jane, take it away.
Our favorite, Facebook.
Yeah.
Is Matt here?
Yep. Can you hear me?
Yes. Hi, Jane.
Yes. Hi, Jane.
Yeah, Facebook this quarter is not doing as well as before. And as you can see on the screen, the current quarter, the sales growth has decreased to 41%, 42%. And even though the trading full quarter is 46%. And also the pre-tax profit has also decreased to 31%. Earnings per share growth also decreased to 32%. So everything across the board has decreased. So based on that, I have projected the sales growth rate to be 23%. And if I can show you the SSG. So based on that, 23% of sales growth, I have projected the earnings per share growth rate to be 21.5% based on the preferred procedure calculation. And this is what I have used. The pre-tax profit margin, I use 45%. Tax rate, I use 15%. This quarter, the tax rate is 13%, so I use 15%. And so that get down to 21.5% of earnings per share growth. So based on that, as you can see, the return on equity ratio is not too bad. It's increasing in 2017. On the other hand, 2018 year is not as well as 2017, as you can see earlier. So, but again, the balance sheet is perfect. There's no debt currently. So we look at the second page. So high price, I take out the outliner. So the average PE for high PE is 49. On the conservative side, I use 34 because the current PE is 34.2 this year. I mean, not this year, 2017. So as I said, 2018 is being deteriorating a little bit. So, but I'm just using 34 for high PE projection. So that gets to $527. And the low PE, I use the current PE 21, even though the average PE 28 for low PE after taking out the outliers. So based on that, the low price are projected to be 113. But even with this rather conservative projections, the upside and downside ratio is 5.8 to 1, and the annual return based on the average PE is about 20%. So we go back to, but with all this, it looks like it's buy, but I recommend it to hold it because at the current price level, $174 as of last Friday. It seems to be it's undervalued. It is because 5.8 to 1 upside and downside ratio. But there are a lot of factors I'm considering to come up with the whole recommendation, because I noticed the active users, the growth rate is not as large as before, and I'm sure you already look at the report, but I'm sorry for the delay to send the report. But my main concern is over the next several years, the management expect its revenue growth rate, and it's gonna decelerate to high single digit. So that means currently the growth rate for sales is about 42%, but it's gonna go into 30% in the next few quarters, even more than 2 years, as it's being told in the conference call. And similar to sales, operating margin growth ratio will also decrease to about 30%, in the range of 30%. And currently, the operating margin growth rate is about 44%. So everything is gonna slow down because of a lot of investments they are putting into. They are putting into a lot of investment into new product growth, even the safety, security, privacy measures they are putting into, they need to invest a lot of money into that, and they are putting into content acquisition, the marketing, and everything. So the in the few quarters down the road, more than 2 years, as management mentioned, the deterioration will continue. But however, we know it's temporary because all these investments are very necessary, and I'm sure down the line we will see financial reward to that investment. However, I think we should consider sell it at the agreed target sale price down the road, possibly after the release of third quarter earnings, because it sounds like there will be a non-recurring gain in third quarter. So the share price may increase, or may because of currently the price at $173, I think it's really quite low. So I don't think we're timing the market, but I think for the next 2 years, we are not going to see a big surprise in earning and sales growth. So I would recommend to sell it and capture the profit when the sales price is, it's going up a bit. So that's my recommendation based on what I have seen in the conference call and the earnings release. Any question?
Yeah, I was struck by you said that management said that growth was going to slow to the high single digits over the next few years.
Yeah.
So high single digits is like 8 or 9%, and you're projecting like
to decelerate. The revenue growth rate to decelerate in high single. Growth rate to decelerate.
Yeah, I remember that announcement.
So what does that mean? So right now it's a 40, it will be 30, minus
30.
9, something like that,
Yeah,
right?
yeah, exactly.
Okay. So that was my question as well, Jane. So thank you, Tom, for asking that. Clarify. So what was your projection then? With their guidance, what was your projection? 23. Okay.
23.
Okay, 23. I think with 23% projection, you still get high price at 700 or 500 something. It's still pretty high to me. Still the high price, because I remember what I learned is that because we want to double our money in 5 years, right?
Yeah.
So with today price is 170, next 5 years, if we can meet 350-ish, I will be happy. But the high price is like 527. So
Facebook's doing pretty well, really, compared. A lot of companies barely grow 3 or 4% a year, and even if they slow down to high single digits, they're still growing more than the average companies.
Yeah, I think we cannot compare Facebook with other companies. We can only compare Facebook with same industry like Google or something. I don't know what's the Google growth rate. But right now Facebook is it's on the spotlight right now, Facebook. So the investigation, the security, privacy, all that.
So they're going to match the European standards and go forward. That's why they're investing. They're investing money to meet the future standards. I expect they're going to go ahead. That's my feeling.
But that is not reflected yet in this quarter's report. So they are going to put in more money, and that will be reflected in the future quarters.
I'm sorry. Can I make a comment?
Yeah.
Okay. So I work with small businesses. I do websites for small businesses, and as of August 1st, Facebook is not allowing them to automatically post to their personal Facebook pages. So where they're used to blogging and setting up an automatic posting to Facebook, Facebook is no longer allowing that due to they're trying to cut down on the spam and where they're doing the whole influencing the media. So they're really trying to put in provisions to make everything more of an organic posting rather than having automated like auto bots. So
What
that's
do you
my
mean?
comment.
I'm not familiar with this. Can you say again? So
Okay.
if I am business owner
and you blog, say you do something on your website, you can
Yes.
automatically, you can set up an automation to post whatever you do, post on your website, you can automatically have it posted to a website, a Facebook, a personal profile page. Well, you used to be able to. Facebook's not allowing that anymore. You could have it posted to a business page, but not to a personal profile.
I do see the announcement about for business, they will have different interface, service-oriented interface for business owner. I do believe that Facebook provide a very good platform for small business especially. For example, if they cannot afford marketing, right? I think Facebook is a good platform.
Yeah.
Yep.
Any other questions for Jane?
So Jane's recommendations, I thought when I see sale, I did not read it carefully. She actually meant to sell at the target rate, 250 or something, 25.
Yeah,
205.
Okay, it's
no.
not, yeah, okay. Okay.
Yeah, just
200,
because
200.
I think we expect in the next few quarters, about 2 years, you're not going to see any improvement in the growth rate, both revenue and operating margin. So I think it's good to capture the profit at this point of time. Yeah.
Do we sell? Okay, sorry, Jane. Go ahead.
Sure, go ahead. Okay.
No, I thought we made a motion of a sell portion of a Facebook, did we?
We did, but then I think we...
Portion did not carry?
It
No,
did not carry.
Oh, okay. Okay.
Even with my vote of yes, but it did not
If
carry.
we sold at $200 and then 2 or 3 years from now it's $500, unless we have something better, why
No,
would
we will put it on the watch list. As I said, the investment is gonna be rewarded in the future. We can always buy it back.
I would hold it because oh well, that's me.
Yeah, but Bernard, remember you use a very big, long word, a huge word, IF, and I think there was enough here to put in doubt whether they're going to reach the $500 anytime soon. But they might. You're right.
They might. Yeah, we don't know. If we have that clear crystal ball, that would be great. But we don't. Yeah.
Yeah. Yeah.
So
we just have to go by see next quarter. How do they do? And
I had one and I dropped it and it broke.
Yeah. Personally, I sold it at about 207.
So you made a profit.
Yeah, before our meeting last.
But your situation different, by the way, everybody. Jane does not pay tax like we do because she doesn't pay capital gain.
Yeah, I only pay withholding tax on dividends.
Right. Okay.
Yeah, that's true. I don't have to consider that.
So I have to consider, long term because
Yeah, sure.
Right.
Well, how are we doing on time here? It's getting close to 7 o'clock. How many more reports do we have?
Move on to next.
Okay, Jay, you're next.
Okay. I'm next. You can give to me.
How do I do it?
Okay.
Can you?
I suppose I can do it myself.
Yeah, can you?
Make presenter. Yes. Okay. So I'm presenting Bank of Ozark. From the beginning, start talking about sales projection, sales and earning per share growth projection. compared to the last asset stock selection guide that Bernard, I believe we worked together, I lowered their numbers only because there are analysts Q&A sessions. The CEO talk about the increasing competitions and their uncertainty about the market. So I lowered a little bit, which I will show you SSG just in a bit. And in terms of a sale, this quarter, they actually not doing too bad. The sales growth is 9%, and then trailing 4 quarters 12%. Pre-tax profit is going up as well, and earning per share growth is also going up. They are current P is about 10.8, average P is about 18. I did cross out I consider as an outlier, which I will show you visually just a second. Upside down ratio is 6.421, and a compound annual return, even using average PE, still will give us 15%. So for bank, I already mentioned when Roy was giving a report, the sales for bank, they calculated by the net interest income plus non-interest income. So the net interest income is they are primary income, the largest category of a revenue. So it's very important. It's the most critical, important objective for banks. So Ozark has done quite well. However, for the non-interest income, they have down 16% compared to last quarter, last year, the second quarter. The net income also went up, increased. Diluted earnings per share also went up 21% as well. I mentioned earlier that the company is facing a new number of competitions, especially in commercial real estate. And also, the CEO mentioned that the increased competition in many ways, in pricing, structure, and cost of a material, labor, everything has been increasing. And also, it made it challenging for their clients when they say sponsors, their clients to find better deals to meet their returns on their equity investments. However, through the conference call, as I looked at SSG, I still like this company's value, that their discipline. I really like how they value their quality over their profitability. For example, for someone's making calls, making deals, if that person made 30 phone calls, did not make any deal, they still reward that person that did excellent work because he's trying to make an effort. Because when the market is good, you never know. In that 30 phone calls, it could be, he could make 1 or 2 deals. So as that person, as long as they reward, they are employees as long as the person's making effort. So they still consider that person did a good job. We have heard about this now it's official. On July 16, 2018, the company changed their name to be Bank OZK. The symbol changed from OZRK to OZK. I was just looking for other analysts, how they value or analyze the Ozark. They, for example, like Zach, still believe that this company will higher growth, will have a strong pace in 2018, even though the increasingly competitive environment may slow down some point, but still believe that it will have a good year. So another news is that they announced acquired 2 new board members. Even though Bank of Ozark is right now, based on the SSG is a buy, but I'm recommending to hold. We have about 5%, I believe, based on what Roy is showing me that show us at the Treasurer's report. As I mentioned, I felt the company still has a quality, the fundamentals still there. So plus that as us here to learn how to analyze bank, I thought Bank Ozark can provide us the opportunity to learn, and I will be a little bit more patient. Hope to see the return growth and to see the reward. And in the past, there were a bank as examiner, Ross Meredith. He gave a couple of ticker talkers classes to talk about how to evaluate bank. So I use his bank evaluation checklist just to go through, how Bank of Ozark perform. So I complete this sheet. Everything is doing well, except the payout percent is declining. But as Bernard mentioned, reviewing my study, he was saying payout ratio is declining, but dividends is going up. Also, another thing I want to mention is the size. Yes, for sales could be small, but in terms, as for bank I mentioned, their revenue is from their total assets, not revenue. How they make money is primary is looking at their total assets. So their total assets in 2017 is about 21 million. So they consider is a median size of a regional bank. Looking at the valuation checks, that actually Bank of Ozark is still considered as a buy because the price over book value is still less than 1.7, just equivalent to 1.7. The price I'm using was last Friday, I believe, a couple of days ago, last Friday. So it's 1.75. So it's kind of at the borderline. But however, we already purchased Bank of Ozark twice, I believe. I would just continue to hold Bank of Ozark. Quickly go through the SSG. So I lowered projections a little bit. In the past, it was 12% on sales and 10% earning shares. So I make a 10% sales and a 9% earning per share. And they are margins going up. Return on equity, the trend, well, 2016 going down, but 2017 is going up. But overall, last 5 years, the trend is going down. Debt to capital is going down. And also another important piece for bank looking at is a percentage of return on average assets. I believe this is considered, this considers excellent actually. I also, let me look there. Do I say trending up? Oh, yeah, 2 points. So percentage return average assets trending up compared to similar bank. So there is 2.2%. So it's considered as an excellent condition based on Ross evaluation sheet. And looking at second page, the high PE, I only give 14. The only reason is that because look at the trend is trending down. I just want to be a little bit more conservative. We have been holding this for a while, a year actually, be exact, is a year. So I just want to see what if I only gave them, current the high PE at the 14. What does that give to us? The high price. So next 5 years can still double, almost double, based on today's current price. And for the low PE, I'm using the recent market low, at 33.5. So that still give us a buy zone and upside down ratio 5.2. Okay, look at the payout just a second. So for the payout ratio, as you can see, is trending down, but the dividends is going up.
That's good.
Do we
Yeah.
are we expecting payout ratios going up?
Jay, why do you want it to go up, or why does Ross? Because
I don't know. At this part, maybe I'm not quite understand. Let's see. Payout ratio.
See, banks may be different, so that's why I'm asking. Because in a regular manufacturing company, if they're paying a dividend, want the dividend to go up, but you don't want a lot of payout. What that is the money that they've made, their profit. They take part of that to issue dividends. And this is, can you put your, well, I've got it. I printed it out.
Oh.
You know, it was up at 30 and now it's down to 21, which means they're using less profit to pay their dividend. Now, with a regular manufacturing company, they can use that for R&D and some other purposes, including, you know, buying back shares.
Okay.
But normally, you don't want it even as high as 50%. I've heard, you know, up to 50% is okay. I like it below that, but you want it to be low. You don't. So that comment about, well, it's going down, so therefore that's a negative.
No.
Maybe that applies to banks, but why would it apply to banks? Because it does not for manufacturing companies.
Okay, I will look into that. So this part, I'm not familiar with this. I will look into, because his checklist saying payout is steady or rising. Obviously, it's declining. I will look into figure out, you know, for bank, what does that mean?
And maybe what he meant was the payout in dividends, is that steady or rising? And he used a different, he used the term differently than what we recognize. I don't know.
Okay, I will reach out to him to clarify that part. Okay.
What I understand, like what Roy said, that if your payout ratio is lower, then you're saving more of your profits to do investments and other things and research. And the bank has to do a lot of research. And so the lower the payout ratio, the more money they have for other things.
Yep.
Yes. Okay. I will, maybe he should change the comment, maybe saying steady or rising is no good. I will ask him.
Yeah, we'll clarify that.
Yeah, we'll clarify that.
Okay.
So regardless, so using the high PE still can give us annualized return about 16%, with average PE will give us about 14.4. So I'm recommending hold in our club portfolio. So if you don't have a bank in your personal portfolio, it is a discounted price. Today's price, I believe, is a 40 something. That's yesterday's price, about 40, 41.
Okay.
This is a long shot, but this bank could get an offer. Somebody could try to buy it, a bigger bank. It's a really good bank.
I think that they are actually, one of their strategies is that they actually acquire other banks.
Yeah.
So far,
but
they have been acquiring other banks to make it bigger.
But it's such a good bank, somebody might want to acquire them. I don't know. It's a possibility.
Yes.
Okay.
Okay, that's my report.
Okay.
Next we have Matt. Matt, I'm going to make you a presenter.
Okay. Let me pull this up. Sorry, I thought we didn't do the holds, so I'm not ready.
Oh, sorry. I can go ahead if you want to.
I can do it. It'll be really quick. I don't really have much to say.
Okay.
Okay. So you can see this, I guess?
Yes.
All right. So sales growth projection, I had at 15%, and then the earnings per share growth at 17%, which I revised those just a little bit downward from where they were before, just to match closer to the analyst estimates. So last quarter they were at 8% sales and then 37% earnings growth for sales and earnings. Yeah, last quarter. Anyhow, so year over year, the recent quarter was 12.5, so they're slowing down a little bit from where they were at 19.4. Pre-tax profit is about in line to where it has been, and then the year over year earnings has slowed quite a bit from what was at 74% down to 43.5. Just keep going. The current PE 23.8, so a little bit above the average PE 20.2. Upside downside with the 15% sales, 17% earnings, growth is a 2.9 to 1. And let me open the SSG really quick. But basically, it's a hold is the short version. Okay. Sorry about that. But the high PE that I used, it opens here. There we go. The high PE, so a lot of these were crossed out because they were in the 30s and 40s. And the PE right now has settled in kind of the low to mid 20s. So using that, I did a high PE of 24 and then a low PE 15.7, which is just the average based on the PEs that we kept here. So using those two.
Back to that low price again?
Yeah. 15.7.
If you look at the low earnings per share forecast, you have 791, which is last year, and the trailing 12 months is 9. So if you upgrade it, do the manual update, that'll increase your low price and probably put it in a buy range.
Increase it to what?
Just click the manual update. And
I'll click it.
The trailing 12 months,
gotcha.
yes, will kick in.
Okay. Well, yeah, that puts it at a buy then.
Yeah. That's why you were, if you go back up to part 3, you can see for 2017, it was 791, and that's what it defaults to. But you can change it to the trailing 12 months.
Gotcha. Okay, got you. Yeah, I guess I have to think about that because they have the impact of the Tax Act.
What was the other thing I was wondering? Could you go to the quarterly data real quick?
Yes, if you look here in the fourth quarter, they have this negative 35.7% income tax rate. So that's where a lot of that 791 came from. Their guidance.
If you go to the third column, no, go back. You can see $204 was the earnings. Or wait, I'm sorry, $3, which was a 204%, way higher than the others. So I would guarantee they got quite a benefit from the Tax Cut Act. And so you got to go in and make that adjustment.
Okay.
Which again will then probably lower, and maybe you'll be back to a hold, but I don't know because that number is influencing your SSG.
Sure, I can make that update. I think the main reason for the hold is I just started following it, and I don't really know anything about them.
Oh,
the short story.
Roy, can I ask a question?
Yeah.
What do you mean by how do you make an adjustment?
I'll show you when we get to Comcast.
Okay. All right.
So you would go annual data, right?
Yeah.
Or quarterly data?
Both, actually. I start with quarterly and I go back up to annual.
And then which one was it? The EPS? So you just click in it and then you type the number that you
you look up to see what the adjustment should be based on, what the usually they'll now come out with a non-GAAP EPS. And that's the one time I use non-GAAP if it's because of the Tax Act.
Right. Yeah, I should have done that.
Figure that out. And for the quarter, you just use that amount. The other, for annual, you have to subtract from the total and you get a new number. So it's easy, but it's not a snap of the finger.
Yeah. The quick way that I would have done it is just make the tax be about what it was in prior quarters. And that's a quick, dirty way if you want to not be so official about it.
So should we be doing this with all our stocks?
Absolutely.
And do we just adjust that one quarter?
Yep. and then you lock it in,
Okay.
so you don't have to do it every time.
Okay.
Yeah.
And you know, if you watch the webinars, there's been a couple of ticker talks that have addressed it, and in fact, the last one, I think it was last week, showed again how to do it. And there's a couple webinars I really recommend everybody watch.
Okay.
Okay.
All right.
Yeah, so looking at that, there wasn't really any other big news. Oh, they did increase their share buyback program by 500 million, and they've already purchased $1 billion since 2016. So that's positive. So it's all positive, no negative news. Nothing really great one way or the other. But I said hold, and it's probably a good buy candidate if it drops 5 or 10% more.
I can't remember. Is this company still considered a small size company? What's their revenue? I don't remember.
Let me go back here. So trailing revenue 2.3 billion. I'm not sure what the ranges are. Is it?
Oh wait, no, medium size. 1 billion is small, less than 1 billion. Yeah, so it become median already. Yes, it was.
Barely.
Right.
Yeah.
Yeah, looking at it, all of our medium, you know, our mid-sized companies are all way down. I mean, they're close to almost small, so they should have pretty good growth rates.
Mm-hmm.
They're not pushing up on the larger limit, so that's good.
Yeah.
Yep.
Okay.
Okay.
Are you done?
That's all I had. Yep.
Okay.
Who's next?
I am. Let's see.
Joanne, is that you?
Yes.
There you go.
Okay. I need to pull mine up. Okay, so I have PSA.
You may want to close the IPC if that helps.
Oh, yeah.
Yeah.
Okay. I thought I had it up, but I have my Better Investing. Okay. So this is Pacific Public Storage, and they are a REIT, and we used to hold O Realty, and that was also a REIT, but we sold that last month. We're still holding on to PSA because of it's an educational opportunity, understanding how REITs work, and because they're based on using FFO, funds from operations, versus EPS. So I didn't change the sales projections or the EPS growth projections. They're still at 5%. The sales growth, the recent quarter, is down a bit from the trailing 4 quarters, and pre-tax profit is up quite a bit, and EPS growth is down. So the pre-tax profit is the first positive quarter over the past 5 quarters, but the sales growth has been decreasing over the past 14 quarters. Let's see. So current PE is 23, average PE is 22.7, so they are over the average PE. Their upside downside ratio is 2.2, and the compound annual return is 8% using the average forecast, the forecast for average PE. Okay, so REITs are evaluated on different criteria. So their current debt to capital is 22.6%, and less than 40% is considered excellent. So they have a excellent ratio there. And then they don't have a floating rate debt. Let's see, they have a good history of dividends. Oh, did I? more than 25 years. And then shares outstanding is 174.2 million. Okay, so this was interesting when you guys were talking about average payout, because their average payout with REITs, that's how they spend most of their money on paying out. So theirs is 74.1%. And
Yeah, Matt can correct me, but I think it's 80% they need to pay out. I know there's a certain limit because they're not taxed on it if they pay. There's no capital or corporate taxes if they pay out most of their profit to the shareholders. It's if they drop below a certain level, then they're heavily taxed.
okay,
It's a special tax thing that REITs have.
okay. So then they're also evaluated on their rev path, which is the revenue per available foot. And so they're up 2.4% on their revenue. They also are measured on their net operating income, which is also up 2.7%. For the last quarter, though, they missed their projections on their funds from operations. They missed by it's like 2 cents, and then they also missed on their revenue. And their occupancy is decreasing from the same time in 2017. It was actually I got that backwards. Sorry. So it was 94.7%, and it's 93.7%. I'll correct that. So they're experiencing the softness in demand in their major markets because it seems like there has been competition from newly constructed self-storage facilities. And then they are having to reduce their rates to be competitive to get more higher occupancy. Let's see what else. So, so they're based on the projections, because they do have a high dividend. These shares are recommended as a conservative income-minded investors, because you'll get a regular dividend. Their safety is rated as a 1 by Value Line, but they're not considered. Their return is considered underwhelming because the interest rates are going up, and it seems like they're struggling with occupancy. So I didn't have any new judgments for the SSG, but I would like to take a look at it because I didn't do the correction on the taxes. I'm not sure how that affects this particular stock. I'm recommending a sell on this because of the deteriorating fundamentals, that their revenues have been continually going down, and we can take a look at the SSG with that. Okay, so this is their SSG, and average high PE. Okay, so even with the sales growth was 5%, I'm wondering, because I'm not sure how the guidelines apply to a REIT. I know that we were in the past, we talked about it not being more than 1.5 times. So I don't know, Roy, do you have a comment on? I just use the lower, use the 2017, since it seems to be dropping, to use that as the
What's
average
the
IP.
current price again?
The price?
Yeah.
220. Oh wait, I need to update this. Let's see.
So according to the Morningstar, we are ahead. So if we sold it, we will get a gain. You know, REITs are so different, but we did it so we could learn about them. But you know, if the analyst on our team says sell, then I'm not going to challenge that because it baffles me sometimes.
I wonder, what did we buy it at?
We bought it at 216.
Okay, it's at 223 now.
Yeah. So we didn't make a lot of money, but we made you know, better than some.
Yep.
Okay, let's look at the. Oh, I wanted to look at that. Okay, so they don't have taxes. Is that right?
Not if their payout is high enough. I just don't.
I think that's right. Yeah, they have to pay out 90% of their taxable income, and when they do that, they don't have to pay taxes.
Okay, so but look at their let's look at their payout. Hold on a second.
It's 90% of taxable.
Oh, so this payout is 82.5%, 2007.
Yeah, but you know, it could be fuzzy math in there. You know.
Okay.
Yeah.
They're using my accountant to get down.
Okay, so they don't have. So that's interesting too. That they don't. We wouldn't adjust anything in their quarterly data.
Right.
The shareholders pay the taxes.
What do you mean?
In the dividends.
Oh, in the
On the
okay.
dividend, the
But see,
shareholders.
to me, this is the way dividends should work. Only when we get a dividend from a manufacturing company, it's taxed twice. The company has to pay, and then we pay. At least this way, it's only taxed once. So
Okay.
I think it's cleaner, but that's the right wing over here.
No, that's true. That's true, Roy. You're right.
Okay, and then this is the quarterly data. See, and sales has been going down steadily for I think, did I say the last 15 quarters?
I think you said 14, but yeah.
Yeah. So I don't know. They seem to be struggling. I don't know. You know, if people are not using storage units like they were before when it's not as popular. Well, I think the millennials aren't acquiring possessions, and it's like that whole the trend is not to, like, what do they want? They have experience over possessions.
What I've heard is that it's during recession that storage units are used more.
Yeah, I was just
people
going
have-
to say that. Yeah. That's
Okay.
my understanding too.
Okay.
We're having good times now, and so people don't use them as much.
You know, they're not losing their job and downsizing or moving to another state,
Right.
you know, for a job at nearly the records that they were before.
Okay.
So as soon as we sell, we'll have a recession, and we'll want to.
Okay. So that's fine.
That's a little bit.
Okay. Are there any questions for PSA? Okay,
No.
the next one we have, let's see, is
The last one, Comcast.
oh, Comcast, and then Mina too. Mina's got IPGP. Okay.
Mina's back. Oh, Mina's here. He's
Okay.
quiet.
Okay, I don't
Oh yeah, Mina's up.
should we do
Mina, do you want Mina go first?
okay, have Mina go first.
Yeah, actually, if you could just control the screen. Sorry, I just have
Yeah, I
a
got
motion
your
up and
screen. I got your
that's information. Yeah,
Okay.
thank you.
So IPGP. Just
Okay.
tell me when to move on.
Okay, great. Yeah, thank you. So last quarter sales were disappointing for IPG. the cause by management kind of blames that on kind of trade disputes and global geopolitical issues, softening markets in Europe and in China. But despite that, they still did show positive growth in most of their products and continue to be appears the leader in laser technology there. So I've adjusted the SSG from 13.5% growth to 12%. That's just based on management's guidance for the remainder of 2018. It's down. It's a downturn. Projections went from like 10 to 15% growth to 7 to 9%. So that just adjusted it to 12, but the 5-year forecast still looks good. Earnings per share put at 12% as well. The growth was good for the quarter, just not as high as they expected. I believe it was $361 million in revenue. I think they were expecting a downturn given the tensions with China and trade wars because the majority of their projected growth is in these low end or budget lasers for kind of mass production, mass manufacturing, and so they're looking to position themselves in China. So once hopefully these trade tariffs and trade issues resolve themselves, they'll continue to show healthy growth. So this stock, we're expecting, I think, a dip in 2018. The prices dropped dramatically from the 12-month high. I believe it's almost 40%. But I still think it's a good growth company. It's still well managed, and they still seem to be the market leader, and they're expanding their portfolio with new products. Management seems relatively optimistic on that front, but with a grain of salt, of course. But so the more modest growth for this year might scare off investment, but I think for now it's still good value for the price given the potential growth. And I think it might drop for the meantime, but I think it is still well positioned. So I've put it as a hold. If the year continues, if the downturn continues, then I think we can sell off without much loss to our portfolio. But I've left it.
Thank you, Mina. IPGP was our superstar.
Yeah.
Until this was it last week or a couple weeks ago?
Until
the earnings come out.
We had the one day management's projections. I still think they're strong. I think the sell-off is maybe a little bit premature, but I still think it's still a good company. It's still going to show good growth, I think, and but just short term, there's going to be a loss for sure.
So is this a buying opportunity?
I'm not sure if it's there yet because it seems all the research I've done, it points to pessimism for the rest of the year in terms of the price and kind of where it is right now. So I think there's expected continued loss in the price this year. So I think it might be a buy candidate going forward, maybe after a third quarter if we kind of look at the fundamentals, we're still happy with them and their projections. And if the price drops, then I think it might be a buy candidate then for sure.
I wish I had waited until after your report because a couple of weeks ago I bought a whole bunch.
I don't think that's a bad thing at all. But I just think you can get you might be able to find even better value next quarter if more people sell off, and there's a little bit of worry if the tax and tariff issues prolong themselves. So I think it's still a good buy for sure. But I'm being cautious. I'm just going to hold.
What about the SSG?
Based on his SSG, actually, it is a buy.
It's a buy. It's a 4-to-1 ratio on the SSG. I used the same projections with 12%, and the EPS, the PE ratio is still, it's still pretty consistent with the 5-year high and average. So, assuming those numbers, I took those numbers to be roughly what we'll expect as projections and it still turned out a buy. So it is good value, but I think we might get better value if the price drops. That's all.
Based on Mina's SSG, it is a buy, but the return with a high PE is only about 12%. annualized return, with average P will be about 7%. Still back then the bank interest rate, but yeah.
Okay. All right.
Thanks, Mina.
Thanks, Mina. Okay, next we have Comcast. And that's Bernard.
Yeah.
Bernard,
So
do you have it up?
I'm trying to. Let me see.
Do you have it up, Jay?
Yes.
Okay.
Do you want? Okay.
Yes.
Comcast.
Yeah.
Okay.
I don't have.
Okay, Bernard, Jay's going to bring it up for you.
Okay, you can make me a presenter.
Okay.
You can just talk through it.
I can talk. Yeah. Okay.
Yeah. Go ahead.
I see. Oh, okay. Here we go. So, though this is not mine. This is
yours. This is here.
I did a newer one.
Oh, I don't know. I don't know where it is. This is on the Google Drive. This is where you have August 15.
I did a new one. Well, I filled in these blanks on the last SSG.
Okay, why don't you tell us what they are?
Okay. Here, I got it printed. So the last SSG sales growth were 5%. And the last earnings growth was 5%. And when we get down to your most recent, and I got these from you. Most recent quarter year-over-year sales growth, MRQ 3.7. No, 3.7.
Oh, I looked. It was 4.1. I made a notes for you in here when I was reviewing your report here.
All right. Well, okay. And then I have 9.9 as profit tax.
Oh yeah, you're right. Right, 2.7. That's correct. Sorry, I looked around I was looking the
3.7. 3.7.
Trailing quarter. Yeah, 2.7 or 3.7.
3.
I have 3.7. I'm not sure. The handwriting was not real clear, but
I have 2.7.
Well, that's because you were supposed to look it up.
Okay.
But we'll get there. We'll get there.
We get there.
Okay.
Go ahead. Keep going.
Okay. And 32.7. That's your. Okay. The rest of it I have. Okay. Now, so the current PE. All right. Now is the stock. Okay. Wait. Current PE from the SSG is 7. The average PE is 15. Relative PE is 46%. So this could be a bargain. Upside downside ratio from me is 6.9 to 1. Compound average return using the average PE 17%, 17.7. But here's some problems. The debt to capital is about 50%. They have a lot of debt. And cord cutting is cutting the cable business. And they're having to expand into other things. And like they're trying to buy like Sky, which is a European cable company, but that hasn't gone through. There is insider purchasing at a significant level. In the last 6 months, the insiders have purchased 2,275,000 shares. PEG ratio is 0.86. So compared to the growth, the PE is low. It's a very diverse company. They have field telephone service, internet service, theme parks, NBC television, cable television, film creation. There's 3 or 4 films. Fallen Jurassic World film, even Universal Studios in Japan, construction of a Universal Beijing resort. They did the 2018 Olympics. They did the 2018 Super Bowl. So they're into a lot of stuff. It's a big company. Now, okay, let me go to my SSG, I guess.
Okay. I don't remember. Let me take a look if I have downloaded your SSG. Hold on. CM Comcast.
CMCSA.
Hold on, just a second. Let me, it's all steady. I put the wrong. I do not have yours, but I can do a quick change. Oh, it is 5. Did you say you changed this is the last one. Let me do an overriding very quick.
I sent it up.
Yeah. So did you lower your projection? You lowered to 4 and 9, right? Why do you lower them?
Okay. Well, the sales are not, because the sales are not very, in fact, some analysts give negative sales for the future.
Mm-hmm.
And it's between 4, 7, there's quite a few analysts with different estimates. And so I felt that estimating 5% is too high for sales. But what the funny thing about this company, where they go up, is in their earnings. See, the earnings curve is going up pretty well.
Don't we need an adjustment there? That's got to be an artifact.
Well, I think it's a tax thing. The tax.
Well, yeah.
I told you about it, but you didn't adjust for that, so I'll show you how.
Okay, do you want to do it now?
I tried, I didn't know how. And I tried, and by the way, you're not showing pre-tax profits.
Should I change to what, Noy? 34.5 for the tax rate? Just use it cheaper rate.
Turn it, give me the screen.
Okay.
I did turn this thing up, but pre-tax profits not showing here. We should click on that too.
Roy is going to show us how to fix the tax rate.
Okay, I thought I clicked to do it, but is this mine?
Yep.
Yes.
Oh, okay. So you can see this is a big jump. And when you come over here, you can see under earnings, I mean, let's go with sales. You know, they're back in January of 2017, it was a 4%, but they showed 561% increase in earnings. Earnings have been in the 40 to 50 cents, and then suddenly it's 314. So you know something is really off. So let's see, where do I have that?
Now this looks like mine because I only did 5 years.
Well, yeah, bear with me. There it is. So what I did, what I Googled was Tax Cut and Jobs Act impacting CMCSA for Q4 2017. And I got this Thomson Reuters article.
Yeah.
And going down, let's see here.
It's about 80 pages. I printed it out too.
Well, yeah, you don't have to do that.
Oh.
Let me just
okay.
Command F, tax cut. Okay, that was the wrong one. Taxes. So in here, they talk about.
I think Tax Cut Act.
You don't have to put all that in when you do a search.
Okay.
So they talk in here about how they're adjusted. Yeah, let me do it this way, adjusted.
Isn't that what you need?
Earning per share 0.4. I think he's looking for.
Okay, so
here we go.
They're adjusted was 49 cents. So let me go down to this next one. You can say adjusted earnings increased to 49 cents. Well, that's a lot less than that $3 and something. And when they talk about it, they talk about that it was because of the Tax Act, the Tax Cut Act. So I got that information. And so again, you go up to the data, quarterly data, and you can see the earnings per share at $3.14, and it should be 49. So what I did, put in the 49 and making that adjustment, and I also adjusted the tax rate. That automatically locks. So the next time, if I use this SSG and I keep updating it every quarter, these numbers won't change. If I bring it up new, then I have to go back in and make these changes. So anyway, so I made it there. I figured out, what I subtracted 49 cents from $3.14, and that gave me a new number that I subtracted from the annual. So I dropped that down because that was $4 and something. So you can see I made that change. And now you see this is more rational.
Mm-hmm.
Where did you get the 20% tax rate?
Somewhere in one of that discussions, it was around that.
Okay.
It's 21%. I figured it didn't matter if I got that identical. Here's the debt that Bernard mentioned. But what I did by doing that data change, that gave you a more realistic line, and that also thus dropped the 5-year estimate out. I forget now what Bernard's was.
9%.
Not $9? No,
9%.
Well, okay. But see, it's $7.75. That's why you have such a huge upside down. But when you go and put it more reasonable, you can see it's only $3.51 projected out. And so looking at that and making, but this was the only thing I changed, because everything else I used your numbers, Bernard, and I come out with a 0.6 to 1. And only
Now,
a 1.5% return.
Is the low price reasonable? I mean, what's the forecast low price?
$11. Let's see, that's based on, well, like I said, I used his numbers. Now, I'm not sure 5% low PE is reasonable. Given, I would use a higher number.
What's the 52 weeks low?
Well, let's see,
$30.
Is
Okay.
30, but that's this year. The 52 is 26.
Right.
So let's say I use that.
It was 26 better.
But see, that still only kicks it up to a 1.4.
Right. I believe
if I did some other manipulations, I got up to about a 2.2.
Yeah.
But anyway, that's what you have to do with these. Otherwise, you get really erroneous SSGs. You have to dig in, find out why that. Let me go back to this. Why this occurred? I mean, that's craziness. And so you dig in, you find out that it was the effect of that tax act, which affected something like 70% of the companies. Now, sometimes it actually reduced their earnings. Sometimes there was a charge. Sometimes they got a benefit. Here they got a huge benefit. But you have to take that into account and make that change up in the data fields.
Yeah. So the tip-off is the pre-tax profit. The earnings and the pre-tax profit should sort of track each other.
At this point, they should. Let me see. Let me go back.
I mean, if there's a big divergence, then you need to look into it.
Come on. So as you can see, the earnings is still going up, but that's probably because of share buybacks. I don't know that. I didn't research it, but I'm sure that's what that is. But it is a lot closer to the pre-tax profit than before.
Okay, we have.
Now, if
By
you
the
go
way,
into quarterly data, go into quarterly data, check on quarterly data. I want to show you, there's something that came up. I don't know, maybe you'll get it or not. Okay, now click on pre-tax. No, go down, see the graph, and show the pre-tax profit. You're just showing the table. Yeah. Okay, now, yeah, pre-tax. Well, okay, it's different now than it is on mine.
Well, that's because, okay, let me go back to yours. But see, pre-tax profit is pretty much the same. The reason why it probably looks different is I don't have this big kicker in there. So you get, let me get rid of earnings. Now, see, this looks like mine. And the reason is just because it compresses the graph visually. It's the same data. It just compresses the graph if I put earnings back in. See how it collapsed? That's because this is so high, 165%, which, I mean, if they really made that much profit, that'd be wonderful. But they, that was solely because of the taxes.
But that's what I had, and it looked bad because the sales are flat and the pre-tax profits are flat, and yet the earnings are way up.
See, if I take out earnings again, that's the same lines as on yours if you take it out. But here, it still compresses it a little bit because of back here, but that's only 32. That's, not 162. So the graph is still a little bit expanded, a little compressed, but also expanded. So you have to be careful when you look at these things. What is it that's causing it to look strange? But it doesn't change the numbers. It only changes the visual aspect of it. And then if we do the profit margin, it's been pretty flat, 17-18%, which isn't bad. But I think when yours, let's see, what will it look like?
0%.
That looked the same. But so you just know that this is wrong, and you've got to dig in and find out why, and then make the adjustments, and you got to do that for almost all stocks. A lot of them you don't, but I think it's only about a 30% don't. There's about 70% you got to go in and make that adjustment either up or down as called for.
Thank you, Roy. We have about 7 more minutes till the end of the meeting. So
just a comment that Henny sent out email about Disney winning the purchasing Fox. That will be against the Comcast. Unfortunately, Andrew's not here tonight to present Disney, so it will be very interesting.
Okay. Do we have any discussion?
Well, go ahead.
Go ahead.
I make a motion by Skyworks.
I second that.
Discussion?
Surprise.
What's the percentage against Skyworks of 5%?
6%, I think.
Okay.
And I think we bought it twice.
Yeah.
We did.
But
January of 17 and February of 18.
Yeah, we can buy it twice now.
Okay.
I think once is enough.
Okay.
One more time is enough, I mean.
Does everybody have their ballot?
Oh, we got to do that, don't we? Okay, hold on a second.
Search by Joanne's name because she sent out yesterday.
Yeah.
I have trouble navigating stuff.
Find this craziness here.
Yeah. Are we voting now?
Yeah.
Okay.
Here we go. Well, maybe I can.
Okay.
Oh.
I'll have to dig it out. There's the voting. Why do I have to put in my address?
No.
Sorry, I'm unable to open the file at this time. Please check the address. Try again. What is it? Are you guys
Now,
getting
your screen
errors?
is showing, Roy. Okay, there we go.
Are you guys getting errors or just me?
I'm fine, I think.
Okay.
How many votes do you have, Joanne?
Let's see. Wait, do I have
For
the?
some reason, I have to input mine twice, but there it is submitted.
I
It's
said
been
I guess
recorded.
that was good. I'm getting errors. Says sorry, unable to open the file at this time.
And I don't know what's going on with my
I
Chrome.
can't seem to vote either.
What
You're-
error did you get?
Well, it's just
Oh, okay, I
not
voted.
letting me.
Okay, so what
Okay.
did you do is that, do you know on the top it says having trouble viewing or submitting this form, fill out in Google form? Click that, you're able to vote.
Oh, okay. Okay. Thanks.
Okay.
Fortunately, what Joanne sent me works great.
I can't enter my email address. I
What
can
error
hit the button. There's no error, but it won't let me type in my email. I can click a button, but
So
Move
you
your
typed
mouse
in an address and then you clicked on some, you voted yes or no, and then hit submit. Click
well,
submit. It didn't
I
go
can hit the button, but it won't let me type in my email. It's just
Well, but move your mouse around there. The email address on mine appeared kind of above where I anticipated it would.
oh well.
Okay, I'm just looking at results.
Yeah.
Actually, okay, we have Megumi and Joanne used to vote, but right now is 71% is yes, 14% no, and 14% abstain.
I vote yes.
Okay.
Well, 71 should carry it. So.
Yeah, it should
Yeah.
carry. Yes, carry the motion. Yeah, carried
Okay.
by Skyworks. Okay. All right. Next, Joanne.
What do you mean?
Are you going? I don't know if any other motions there.
Oh, are there any other motions?
Yeah.
No.
Do we want to sell PSA? Joanne recommended that.
I think it was really a hold this time. I think it was sell later, but I could be wrong.
No, I think that was Facebook.
Oh,
Yeah.
Okay. What else is a buy? Is IPGP a buy? Skyworks a buy? Bank Ozark is buy. Yeah. Buy more Facebook? I'm just kidding.
well, we've got the money.
Should we buy
Yeah.
more IPGP? I feel like I don't know. I feel like IPGP is pretty decent company, and we made a good profit.
But
on that.
the return
And
is low.
because of, not because the company's management, it was because the political reasons, right? And Mina, that was my understanding.
Pardon me?
The earnings went down
Yes.
this quarter. It was not because of the management or fundamentals. It was
No.
because of the trading war.
I think that's largely what they attributed to, yeah. That and softening demand in European and Asian markets, it seems, but I'd say largely the trade war, yeah.
So maybe wait and see how things shake out.
Well, yeah, that's basically my approach to it too. I think it's still a good company to hold long term, but if it keeps, if we're still seeing underperformance, then we probably sell off at some point. But if we see a good buying opportunity, it might be there too. So do we stay flexible?
Okay.
Okay.
So I think I'm going to close the meeting.
Okay.
Anybody?
And then open up to our attendees.
Yeah.
Yes.
Okay.
There are a couple of questions, by the way. Let you know.
Okay.
Okay.
So I'm going to stop the recording and then we can. Okay, so I'm adjourning the meeting and then we'll open it up to guests.